Today, I want to talk to you about the pig, and I'm not talking about our farmyard friends. I'm talking about the passive income grind, which arguably has the best acronym in all of tax planning, the pig. In early 2019, new tax rules came into place that changed the way your active business income interacts with your corporate investment income. If you earn passive investment income of over $50,000 inside your corporation or your holding company, you may come face to face with the pig. Here's how it works and how you can wrestle it. Canadian-controlled private corporations, or CCPCs, pay less tax on the first $500,000 of net business income. Income over this is taxed at the general rate. This $500,000 limit is called the Small Business Deduction, or SBD. In BC, the small business tax rate is 11% and the higher general rate is 27%. The PIG reduces your SBD when you have corporate investment income over $50,000 in a year, dropping it by $5 for every $1 of investment income over this amount. So if your investment income is higher than $50,000, you might pay tax on more of your practice income at the higher general rate. Once you hit $150,000 in investment income, your SBD is reduced to zero, and all of your active business income is taxed at the higher general rate. Here's an example. Say Dr. Green is a cardiologist earning $700,000 per year in net corporate income. She has a holding company with a $4 million investment portfolio paying $120,000 per year in investment income in the form of dividends and interest. What happens? Well, her SBD will be reduced. Her investment income is higher than the $50,000 limit, and her SBD is reduced by $350,000. Under the old rules, she'd pay about $109,000 in taxes that year, but because of the PIG, she pays $165,000. That's a difference of $56,000. But it's not all bad. Income that's taxed at the higher general rate creates a general rate income pool known as GRIP. Income in your GRIP is paid out as eligible dividends, and eligible dividends get an enhanced dividend tax credit, so they're taxed lower than non-eligible dividends. As for Dr. Green, because more of her income was taxed at the higher general rate, she has a higher GRIP than she would otherwise under the old rules. That means she can pay more eligible dividends to herself. If she paid it all right now, out of her corporation and to herself personally, the impact of the PIG would be minimal due to tax integration. It means the combination of personal and corporate taxes should result in roughly the same outcome. But what if she didn't need to pay it all out? And what if she kept it invested in her holding company? Well, that's where the PIG gets you. That's how the PIG wins. Since she paid $56,000 in additional taxes on her practice income than she otherwise would have, she's lost some tax deferral until she pays out that GRIP. Basically, had she not been subject to these rules, that extra $56,000 in tax could have been used to invest. So what could she have done? Can the pig be tamed? Yes, it can. There are a few ways to avoid this outcome, but there may be unintended consequences. Option 1, pay salary. Salary is deductible to the corporation. If she paid herself a salary, she could have reduced her corporate net income dollar for dollar, leaving less income to be taxed at the higher general rate. But salary is fully taxed to the recipient. Assuming her tax bracket was higher than 27%, paying salary that she doesn't need right now would have just accelerated her tax bill. Option 2, reduce corporate investment income. By focusing on investments that will grow in value instead of paying an income, she may be able to reduce that $120,000 of investment income that her portfolio is producing. But be careful letting the tax dog wag the financial planning tail. You don't want to eliminate bonds in favor of riskier assets if that puts your portfolio outside of your risk tolerance and risk capacity. Option 3, reduce corporate investment assets. If Dr. Green's corporation owns a permanent insurance policy, she may be able to shift investments out of her investment account and into that policy. With permanent insurance, you can contribute more than the cost of the insurance itself. Any money in the policy that is not used to fund the cost of insurance can grow tax-free, so long as it remains in the policy. And this growth is not considered when calculating investment income for the PIG. But life insurance should only be purchased if there's a real need for life insurance in the first place. So for example, if she has family that relies on her ability to work and generate an income, or if she's expecting a very large tax bill on death and wants to use insurance to cover that amount. Insurance generally shouldn't be purchased solely for its ability to shelter contributions from tax. Option 4, she might also have an individual pension plan, or IPP. Often called a supersized RSP, it allows employers to make pension contributions for their employees that are larger than the RSP contribution limit. Money in an IPP is tax deferred and not subject to the rules of the PIG. They can be beneficial, but they're more complex. Additional costs and reporting are involved in setting up and maintaining an IPP. They're also less liquid and a little bit less flexible than a corporate investment portfolio. In all these cases, avoiding the PIG requires a sacrifice. At the end of the day, the best option may be to face the PIG head on. Accept the loss of tax deferral. Work with your accountant and your financial advisor to reduce the implications to the degree possible, and get on with your life. If you found this video helpful, please share it with your friends, family, or colleagues. And as always, if you want to chat about any of this further, please feel free to get in touch.